We're now going to turn to how to account for a merchandising company. A merchandiser is somebody who buys and sells merchandise, and they're either wholesalers or retailers. Again, you can read that in your own textbook in terms of which is which and why they're different. But when you're accounting for a company that sells merchandise, that's different than when you account for somebody who's just providing services. There's certain accounts that you have to deal with that you don't deal with in a service industry. So basically, a merchandiser makes money by selling products. And the way that we come up with the net income for a merchandiser is we take the revenue from selling that merchandise and we subtract from that the cost of the merchandise, which is referred to as cost of goods sold, but also other expenses that we might have, just like normal expenses like supplies expense, rent expense, insurance expense. So the difference here is you have this account called cost of goods sold, which is the amount that you pay for the merchandise that you're going to resell. So if you look here at the chart, it shows that for a service company you have revenues minus expenses gives you net income. But with a merchandiser, you take net sales, subtract cost of goods sold, so this is the cost of the merchandise that you're selling. That gives you gross profit, and then you subtract your expenses to arrive at your net income. So there's this extra step in here when you're dealing with a merchandiser. So here's an example of a particular company. This company is referred to as Z-Mart, and it shows you here that they had net sales of $314,700. Their cost of goods sold was the majority of their expense, leaving them with a gross profit of $84,300, and then their expenses are $71,400, and that gives you a net income of $12,900. So these are the different steps that you take that you wouldn't have to for a service industry. Now, when you're reporting that inventory, you're going to have on your balance sheet an account called merchandise inventory, because when you buy these products, generally speaking, at the end of a period, you still have some of them left. You don't get down to zero product at the end of each accounting period. A lot of times it's just called inventory, not necessarily merchandise inventory. So these are the products that you're planning to sell. It's not other things like office supplies that you have. That goes into a completely different asset account. This is just the inventory that you plan to resell. The next section talks about the operating cycle for a merchandiser. That obviously begins by purchasing the merchandise, and then it ends when you sell that merchandise and collect the cash for it. Now, as you can imagine, the length of an operating cycle is going to differ depending on the business. Department stores often have 2 to 5 months, but grocery merchants are going to be quicker than that. You're not going to have product that's going to sit on the shelf for 5 months. So depending on which type of merchandise you're selling, your cycle is going to be a little bit different. This chart kind of shows you how it all works. Keep in mind, a lot of times you're selling merchandise on credit. So when you sell on credit, you don't bring the cash in immediately. You end up with an accounts receivable, money that you're expecting to get, and then eventually those people will pay you, and then you'll have the cash on hand. Now, in terms of how we track our inventory, again, the inventory refers to those products that the company owns and is expecting to sell in its normal operations. So this chart shows you the way that we look at inventory. In a particular period, as I said before, you're going to usually have beginning inventory because you don't always go down to no inventory on hand. You don't generally do that. So you're going to start with your beginning inventory amount. You're going to add to that any purchases of inventory in that particular period. So that gives you your merchandise available for sale. And then you will have your ending inventory after you've sold whatever you're going to sell in that particular period. So you would calculate at the end what the ending inventory is. There's different ways to account for inventories. There's different systems for doing it. And we're going to talk about that next. The two systems that are typically used are either the perpetual or the periodic system. Under the perpetual system, you're continually updating your accounting records for the merchandise transactions. But under a periodic system, you only update them at the end of the period. So you would take an inventory at the end of the period and then figure out what your cost of goods sold was for that particular period. Because of technology, it's so much easier now to kind of keep track on a regular basis, so more and more people are using the perpetual system. It also gives you immediate access to the information that you need. So many companies now are using the perpetual system, but then they still do a periodic inventory every now and then. I know you've all seen that as you've walked into Walmart, where they're actually going around and physically counting the inventory. So they keep a perpetual system, but they also combine that with a periodic inventory on some kind of a schedule that they have set up. So these are the two different ways that we actually account for inventory. Now let's get into explaining how this works on a day-to-day basis.